partnering with Nvidia to launch the high-end CNode X platform. Revenue is exploding in the AI boom, yet the stock has been cut nearly in half from its peak. What exactly is going on with supermicrocomputer? Has the AI hardware boom already been fully priced in? Or does the razor-thin 6.3% gross margin reveal a brutal reality of working hard for almost nothing? Behind the seemingly cheap 17x divided by E, is this a golden opportunity or a value trap with no bottom? Hey everyone, welcome to Stock Market Breakdown. In the AI space, SMCI has always been seen as Nvidia's closest ally, but this latest earnings report has clearly rattled Wall Street. The revenue looks impressive, but a 6.3% gross margin for a tech company is dangerously close to what you'd expect from a traditional contract manufacturer. The CNode X AI platform, jointly developed by Supermicro, Nvidia, and Vast Data, represents a major evolution in product strategy. Its core value lies in its modular, plug-and-play design, deeply integrating servers, GPU clusters, high-speed storage, and AI operating systems into a single unified solution. This directly addresses the long-standing pain point for enterprise clients who previously had to piece together fragmented components, significantly reducing deployment time from data center installation to full compute activation. In simple terms, it turns AI infrastructure deployment into something as easy as building with Lego blocks. In the past, if a company wanted to build AI compute capacity, they had to source hardware from multiple vendors and configure software themselves, a long, complex process filled with risks. SMCI's strategy now is to offer a full-stack solution, essentially a one-stop shop that locks in customers through deep integration. While this clearly strengthens its competitive edge, it also means SMCI is taking a much more upfront integration risk. However, this polished one-stop solution hasn't been able to mask the cracks in its financials. In fiscal Q2 2026, SMCI's gross margin plunged from 11.8% a year ago to just 6.3%, nearly cut in half. This dramatic collapse in profitability sends a clear warning signal. In the high-end AI server market, SMCI appears to lack meaningful pricing power and is highly vulnerable to cost pressure from expensive upstream components. So, what does a 6.3% gross margin really mean? It means for every $100 in revenue, SMCI keeps just over $6 after costs. In a cutting-edge industry like AI, that's paper thin. This kind of bleeding for growth model, if it can quickly turn profitable through scale, becomes extremely fragile. In a supply-constrained environment, even a small increase in component costs could push the company straight into losses. What SMCI is clearly executing right now is an extremely aggressive low-margin, high-volume strategy. By intentionally compressing its profit margins, it aims to attract hyperscale customers who are highly price-sensitive and rapidly capture global market share. While this approach is driving record-breaking revenue, in a capital-intensive industry like AI infrastructure, razor-thin margins leave virtually no room for error. Any disruption in the supply chain or even a slight slowdown in demand could cause this high-leverage growth model to break down. SMCI is essentially walking a tightrope, betting that scale will eventually give it pricing power. But in a fast-evolving tech landscape, customer loyalty is often dictated by who can deliver faster and cheaper. This kind of price war can sustain strong top-line growth in the short term, but it significantly weakens the company's ability to withstand risk. Beyond financial pressure, SMCI also faces two deeper structural challenges. First is its heavy reliance on a small number of suppliers for critical components like chips and cooling systems, meaning its growth ceiling is effectively controlled by others. Second is its high customer concentration, with a handful of major clients accounting for the majority of revenue. If these hyperscalers slow down their AI spending or shift to competitors, SMCI's revenue base could collapse almost instantly. If you can't secure chips upstream, you can't ship products. If your biggest customers pull back, you're stuck with inventory This kind of squeeze from both ends business model makes it very difficult for SMCI to command a premium valuation right now. It looks more like a high-end assembler than a true tech powerhouse with pricing control. From a valuation standpoint, SMCI appears extremely cheap. Its forward divided price is at just 17x, well below the industry average of 28x, and its PEG ratio is as low as 0.61. But this discount exists for a reason. Wall Street is questioning the quality and sustainability of its growth, particularly whether continued margin compression could erode future earnings per share. A 17x divided, i.e. for a leading AI server player sounds like a steal, but in the stock market, chip usually comes with a reason. This valuation reflects deep uncertainty about whether margins can stabilize or recover. If margins keep falling, earnings could shrink faster than the stock price. Declines turning the 17x divided by into 40x very quickly. Even though analyst price targets suggest the stock could potentially double, their overall ratings have been trending downward over the past 3 months, signaling growing caution on Wall Street, with the stock already down sharply from its 52-week high and showing high volatility. Chasing shares at current levels carries significant risk. Some analysts suggest retail investors consider a cash-secure put strategy, which allows them to collect premium while waiting for a more attractive entry point, helping maintain discipline in a highly volatile market. To wrap it up, SMCI is a company standing at what could be its darkest moment before dawn. It is the product strength of CNode X, a massive revenue, scalable at 6.3% margin is a heavy chain holding it back. Do you think this low price, grab market share strategy will ultimately help it build dominance, or will rising costs drag it down? Drop your thoughts in the comments. Don't forget to like and subscribe to Stock Market Breakdown. I'll see you in the next one.